Welcome to part 6 of this series. I'm excited for this one in particular because this concept is not spoken about on the internet in detail on how to use the high time frame to guide the low time frame decisions. So today we're looking at a chart of silver. As you can see, there is a pretty clear downtrend that formed, but how do we know when it's going to reverse? I think this is what a lot of people mess up. Not only when is it likely to reverse, but then how to make money from that. So I'm going to mark out the lows here and then show you what I see that's different in these lows. So in the first low, the distance from it to the second low is about 6.5%. From the second low to the third low, it's only about 4%. So every time we get a new low, it's showing that it's slowing down a bit, or sellers are being exhausted, however you want to interpret it, but it's obvious that if it was so bearish, this next low, the third low, should have been a lot lower. So that's the first sign. I know it's simple, but it's showing that the supply and demand in the chart, which is very important. Okay, now that we've identified that this low is more insignificant than this low, there is a probability that it'll reverse. So how do we make money from it? And how do we use the high time frame to help us with the low time frame? What we want to see in the second low is where all the market participants who were long or betting that the market was going to go up, where do you think their invalidations are, or where do you think they would capitulate on their positions, give up on their positions and sell? It's usually going to be where the lows are. In this case, we have a couple tags of that, which is a good sign because that shows that all of the longs in this range have sort of been bunched up together, right? If they had longed it here, for instance, the move to the low that happened here would have taken them out. Let's say that their stop loss was somewhere in the range. This would have taken them out. And if they weren't taken out, then we know that all the stop losses and invalidations are likely resting at the lows. So eventually that capitulation comes in, but it's not as significant, right? Like I said before, this low isn't as deep as the previous one, which is important. So then how do we play it? We look at the extreme on the second low, and we wait for this to start to regain. So there was two opportunities where you could have taken it, right? There was here on the high time frame, and then this eventually got invalidated. So maybe you got a couple risk reward from this on the lower time frame, but eventually we made another low and we tagged it again. So this is where we want to actually zoom into the chart. Now there's two ways you can do it, right? You can swing trade it and look for the same thing on the inverse, right? So if we look on the inverse over here, looking at these highs, we want to find where it was insignificant. So same thing, right? When we made the highs, how high did it go? In this case, about 4.5%. So let me mark them out first for you. And then on the second one, how high did we go? About 1.7%. So you can see that the highs were starting to slow down as well. So same thing, looking for where all the short stop losses were grouped together. And this is going to be an area of significance. So if you wanted to swing trade it down here, how you could do it is position your entry where the previous market participants got taken out, stop loss near the low, and then target on the other side. In this case, it would net you about 3 risk reward. But how do we get even more risk reward? How do we get even more from the market? And this is a bit complicated and a bit more difficult. But the way we do that is we zoom in. So we're going to be zooming in on this part right here. Okay, so now we're zoomed in on the 5-minute. This is still the same level from the second low that I talked about on the 4-hour. And this is why the high time frame is important, because if I zoomed out as much as I can on TradingView, I still can't see where this line is coming from because it's coming from so far back on the high time frame. But now we can use it on the low time frame. So we wait for the deeper test into this low, and now we have a much tighter stop loss. So we found the low on the lower time frame we can use as a stop loss. So depending on where you enter, your stop loss would be at the low. And as you can see, this is really close. It didn't actually get stopped out. And even if it did, you can take multiple stabs at it and try again because the risk reward is going to be so much bigger. And I'll show you that here in a second. But let's imagine that you entered here when we started to see it regain, almost stopped out. And let's imagine this even was getting stopped out. You could try again on the next retest. And the reason why that's okay is because when we zoom out and we use the other side, the high time frame on the other side, so this is the previous target I showed you when we were zoomed out, the risk reward instead of 3 is now much higher. It's at 9. So we really don't have to win this trade very often. Less than 10% of the time this trade needs to work out, in order for it to be profitable in the long run. So in reality, it could have taken 3 tries before you've gotten your orders filled and the position started to run. But then, as you can see, if I zoom out again, we were able to use this local low as a stop loss and the same profit target to net 9 risk reward. This is really important to use if you want to learn how to do scalping, because the high time frame will almost always take precedence over the low time frame, and this is how you can marry the two together to get much better risk reward and much more successful scalps.